Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Webull.
If you find our talks useful, please consider subscribe, like, and comment underneath. But before we do anything else, I want to talk about a major shift. Just imagine waking up and realizing the government just permanently took the handcuffs off of, millions of retail day traders.
Yeah.
What does that do to the app they trade on? Because today we are looking at a company that just experienced exactly that.
It's a massive behavioral shift. But before we get into the actual details of today's stock, I want to share a really useful research platform for long-term investors. You can check out StockOracle through the special 14-day trial link below in the description.
Right.
And StockOracle, it brings company fundamentals, OracleIQ stock appraisal, OracleValue intrinsic value estimates, AI moat analysis, and stock comparisons all into one place.
It's incredibly handy.
It really is. But keep in mind, it is not financial advice or a recommendation to buy or sell. AI analysis and, valuation estimates, they can be incomplete or just wrong.
Right. Data can be delayed.
Exactly. So always verify important facts and make your own decisions. Also, this is an affiliate link, so we may earn a commission if you use it at no extra cost to you.
Perfect. So, getting right into today's focus, we are watching this major narrative shift unfold with Webull. Usually when people hear about a retail trading app, they immediately think of like short-term speculation.
Oh, for sure. Meme stocks.
Yeah, meme stocks, frantic day trading, that whole chaotic ecosystem. So my immediate question as someone who wants to protect capital is, how does a platform like this fit into a long-term wealth-building portfolio?
It's the right question to start with, because if you are protecting capital, you don't want to just invest in a casino.
Exactly.
The core thesis here isn't just about a single strong quarter. It really revolves around a structural regulatory shift, specifically the SEC's removal of the pattern day trader rule, the PDT rule.
Let's actually pause there and explain what that rule was, because it's kind of the absolute linchpin of this whole analysis.
Yeah, it really is.
For those who don't know, the PDT rule was essentially a financial speed limit. It basically dictated that anyone with an account balance under $25,000 could not make more than 3-day trades in a 5-business-day period.
Which is incredibly restrictive.
Oh, entirely.
If you're trying to actively manage a small portfolio,
you're stuck. If you only had a few $1,000s, the PDT rule meant you were basically locked out of reacting to market news more than 3 times a week. It was this huge bottleneck. But the SEC removed it.
Right.
And suddenly, millions of retail traders took the handcuffs off. They could react to earnings, to news, to, Federal Reserve announcements in real time.
Without fear of their accounts getting locked. And that rule change has permanently rewired how that user base operates. By removing those trading restrictions, combined with Webull's updated active trader tools, there's been this massive uptick in options activity. The underlying engagement on the platform has completely changed. So for a long-term investor, this actually fits a high-growth turnaround profile. You're looking at a business with the potential for durable margin expansion over the next decade.
And I have to play the cautious investor here because I am firmly in this camp.
Naturally.
We need to ask if this is actually a structural shift toward consistent profitability, or are we just looking at a temporary spike fueled by a burst of market volatility?
That's the debate.
Right, because a regulatory change unleashes pent-up demand. Sure, it's like opening the floodgates. But does that demand sustain itself over 3, 5, or 10 years? We have to protect capital first. We can't just buy a novelty bump.
And that tension is exactly what is driving the market's current valuation of the company. It's the defining debate right now. Is it a sugar rush or is it a new baseline?
So let's look at the hard fundamentals, because the numbers from their Q2 2026 inflection are genuinely staggering.
They really are.
But we need to unpack what they actually mean for the business quality.
Well, the numbers are what make this so compelling to growth-focused investors.
Right.
In Q2 2026, revenue hit nearly $199 million.
Wow.
That's a 51% increase year over year. And trailing 12-month revenue growth is sitting at over 47%.
That's huge.
But more importantly, that translated to a GAAP net income of just over $24 million.
Reversing a loss from the previous year. And just to clarify for everyone listening, GAAP net income, generally accepted accounting principles, it means this is the real bottom line, fully burdened profit.
Right.
This isn't some adjusted, like if you squint and ignore all our expenses kind of profit. They actually made over $24 million.
Precisely. The trajectory is decisive. Full year 2025 showed net income of nearly $25 million, which reversed a 2024 loss of almost $23 million.
Okay.
But where it gets truly fascinating, I think, is the margin profile. The trailing 12-month gross margin is a massive 76.5%.
See, that gross margin is software-like. I mean, they are essentially running a highly scalable digital infrastructure business at that point. For every $100 they make, it only costs them about $23 to actually run the servers and, execute the trades.
Exactly.
But gross margin just tells us what it costs to deliver the core service. The operating margin is where the rubber meets the road.
Right.
It shows if management is actually keeping the lights on efficiently after paying for salaries and headquarters and marketing.
And that's the kicker here. Management reported an adjusted operating margin for Q2 2026 of 31.5%.
Wow. Okay.
It shows immense operating leverage. When you have a gross margin of 76%, every incremental dollar of revenue, once those fixed corporate costs are covered,
it just drops to the bottom line.
It drops straight to the bottom line is pure profit. Scale is turning their top-line growth into an absolute cash machine.
Okay, I have to push back a bit on the cash machine concept.
Oh, here we go.
I want to look specifically at the balance sheet. They reported over $653 million in cash and cash equivalents at year-end 2025.
Right.
And operating cash flow was reported at roughly $566 million. Now, if we were looking at a traditional tech company, you'd take that $566 million in operating cash flow, you'd subtract the minimal capital expenditures, which were only about $4.8 million.
Right.
And you'd be celebrating a massive free cash flow yield. You'd say, look at all this cash they can return to shareholders.
But a broker-dealer is not a traditional tech company.
Exactly. The accounting is fundamentally different. Treating a broker's customer deposits as free cash flow is, it's like a casino manager looking at the chips sitting on the poker tables and counting them as corporate profits.
That's a great analogy.
Yeah. I mean, yes, the money is physically in the building. Yes, you can technically earn some interest on it, which is called float.
Right.
But it's customer money. The moment they want to cash out, it's gone. For a brokerage, operating cash flow includes those customer-related balance sheet movements. When customers deposit cash into their accounts to trade, it inflates those operating cash flow figures.
It does.
So as an investor, you absolutely cannot blindly treat that $566 million as free distributable cash that the company can just use for buybacks or dividends.
That is a very fair point.
You have to treat that metric with extreme caution.
It's a crucial distinction. The balance sheet is expanding rapidly. Total assets grew to nearly $3.9 billion in 2025 from $2 billion in 2024.
Huge jump.
But that expansion is directly tied to the trading boom and holding customer assets.
Yeah.
However, even discounting the float, the sheer scale of the gross margins and that 31.5% operating margin proves that the core economic engine, like the actual fee generation, is highly lucrative right now.
So we know the economic engine is humming today. But what keeps running? Let's break down the long-term growth drivers.
Yeah.
If the regulatory change was just the spark, what is the fuel that compounds this value over the next, decade?
We can think of their growth strategy as operating on three distinct horizons. The existing engine powering them today, the emerging engine they're building for tomorrow, and the long-term optionality that could completely redefine the business.
Okay, let's start with what's paying the bills. That existing engine is clearly the post-PDT surge we've been talking about.
Correct. The removal of the pattern day trader rule drove a 66% jump in trading-related income.
Wow.
Taking those handcuffs off unleashed options activity and active trading volume in a way that materially reshaped their income statement.
And options are highly lucrative for brokers.
Oh, incredibly. Due to payment for order flow and just higher trading frequencies in general.
Right. But you can't rely on just one market or one regulatory environment forever.
Which brings us to the emerging engine, geographic expansion. They are scaling globally at a very aggressive pace.
Okay.
They recently acquired Pi Securities in Thailand.
Oh, interesting.
Yeah, and they've launched operations in Spain, Argentina, and Colombia. To put their footprint in perspective, they are now licensed in 35 markets globally and actively operating in 18 of them.
It's a smart way to diversify away from being overly dependent on the U.S. retail trader. I'll give them that.
Yeah.
They're targeting emerging markets with growing middle classes and high mobile adoption. But I have to say, international expansion is notoriously expensive.
It really is.
Customer acquisition costs, or CAC, in new markets can be brutal. You are fighting entrenched local players. You have to spend heavily on localized marketing, navigating foreign compliance, setting up customer support in different languages.
Oh yeah, it adds up.
Buying a firm in Thailand gets you a foothold, sure, but scaling it profitably is another story.
That is the big execution risk.
Yeah.
Are they acquiring profitable users, or are they just buying vanity growth at the expense of those beautiful margins?
Exactly, which is why their third horizon, the long-term optionality, is probably the most interesting part of this whole analysis.
The institutional pivot.
Right. They are expanding beyond retail into futures, prediction markets, private market SPVs through a platform called Monarch Markets, and AI-driven advisory services.
And this is the wild card that could completely re-rate the company's valuation. Let's explain what some of this means, because it fundamentally changes their revenue quality.
Yes, please.
Right now, retail trading revenue is highly transactional. It relies on market volatility. If the market is boring, people trade less, and Webull makes less money.
But institutional services and AI advisory lean heavily toward recurring revenue. And those private market SPVs, special purpose vehicles, those are a game changer.
Absolutely.
And SPV basically allows individual investors to pool their money together to invest in a single private asset.
Like getting shares in a hot AI startup before it goes public.
Exactly. Usually, only billionaires or massive hedge funds get access to that. By offering SPVs and AI advisory, the platform starts collecting management fees and platform fees that don't depend on daily trading volume.
It's stickier.
It is a completely different, higher margin revenue mix.
I also noted they recently completed a share repurchase program.
Oh, really?
Yeah, which shows some serious capital allocation discipline from management.
It does. But my concern remains, are the heavy costs of funding these international acquisitions and building out this complex institutional arm going to act as a massive drag on that 31.5% operating margin?
It's a classic tightrope walk for a growth company. Can they fund the future without destroying the profitability of the present? They have to manage their operating expenses perfectly to pull this off.
So that brings us to the catalyst roadmap. We know the strategy, but what are the specific timeline events that will actually prove or disprove this bullish thesis?
Well, the near-term catalyst is everything right now. And that is the upcoming Q3 2026 results.
Right.
This is the ultimate prove-it moment for the company. We need to see if that massive post-PDT trading boom is a durable behavioral shift, or if Q2 was just a fluke driven by the novelty of the rule change.
Let's be blunt. If Q3 shows a sequential drop in trading volume, the market will punish the stock.
Oh, severely.
The narrative will shift instantly from structural growth to cyclical peak.
Agreed. The market is unforgiving with high growth narratives. Now, moving to the medium-term catalysts, we are watching the maturation of those international markets.
Okay.
Over the next 12 to 18 months, investors need to see tangible user growth in places like Thailand, Spain, and Latin America. But more specifically, they need to see the lifetime value of those customers exceeding the acquisition costs.
The LTV to CAC ratio.
Exactly. If they pay $100 to acquire a user in Spain who only generates $10 in lifetime value, that expansion becomes a massive liability.
And the long-term catalyst is that institutional services ramp.
Yes.
Over the next 2 to 3 years, if this hits, if they successfully build out the prediction markets and those private SPVs, the underlying business model evolves. It reduces their reliance on retail trading volume and introduces that stable recurring revenue.
Which completely changes how analysts will value the company.
But to your earlier point, a strong foundation is required first. The institutional pivot is a great narrative and a major re-rating trigger if they pull it off. But if the retail engine sputters in Q3, they won't get the premium valuation to fund the rest of it.
No, they definitely won't.
Speaking of valuation, let's pivot to what the market is actually asking investors to pay for this business today.
Multiples.
Yeah, we have these massive growth drivers and catalysts, but at what price?
The multiples paint a really interesting, slightly conflicted picture. The stock is currently trading at a price to sales, or PS, multiple of about 6.9 times, and a price to book multiple of 4.15 times.
Let's give that some context. Nearly 7 times sales is not cheap for a brokerage.
No.
For a high-margin software company, sure, that's standard. But for a retail broker, that's a premium price tag. And here's the harsh reality check. If you look at the trailing 12 months, Their net margins are actually still slightly negative at negative 1.6%.
Right, because those trailing numbers include the pre-inflection quarters.
Ex
They include the losses before the PDT rule change really took effect and turbocharged their income.
Exactly. What this means is that anyone buying the stock today at a 6.9 times sales multiple is heavily relying on that new Q2 profitability becoming the permanent baseline.
Yep.
You are paying for the new reality, not the historical reality. You are pricing in perfection, or at least consistency.
And that operating leverage we discussed, that 31.5% margin, that's why people are willing to pay it.
True.
If that margin holds, earnings will grow significantly faster than revenue. The multiple compresses very quickly if revenue drops to the bottom line at that rate.
Right.
A high multiple today can look incredibly cheap tomorrow if the earnings catch up.
Still, we have to note a major piece of caution from the analyst community. Following that huge Q2 earnings pop, at least one major analyst has already downgraded the stock to fair value.
I saw that.
That suggests that the immediate expectations, all the good news from the PDQ rule change, might already be fully priced into that multiple. The easy money might have already been made.
So if the fundamentals are potentially fully priced, what does the market sentiment look like? How is the stock actually trading day to day?
The chart structure is honestly fascinating right now. The stock is sitting around $8.53.
Okay.
From a short-term perspective, it's a highly constructive setup. It's up over 43% over the last 26 weeks.
Wow.
Yeah. And it is currently sitting above its 20-day, 50-day, and 200-day moving averages. The relative strength index, the RSI, is hovering around 66.
So strong, but not overbought.
Exactly. It shows strong upward momentum, but isn't quite flashing overbought just yet.
But we have to zoom out and look at the bigger picture. Even with that massive 43% run over the last half year, the stock is still down almost 45% over the past year overall.
Yeah.
It is trading nearly 47% below its 52-week high of roughly $16.
That is crucial context. Charts show probabilities, not guarantees. This recent run needs to be framed correctly for anyone looking at it. It is a recovery from a very deep, painful drawdown. It is not a mature, safe, established uptrend.
It's climbing out of a basement.
Exactly.
And we saw that hesitation play out in the sentiment recently. On August 20th, the stock surged 14% intraday, likely on the back of the earnings news.
Right.
But it closed only 2% higher.
Ah.
That is a classic buy the rumor, sell the news dynamic. Institutional investors use the liquidity of the retail excitement to take heavy profits.
Makes sense.
However, the stock rose over 10% the following week, which proves demand is still very firm. Buyers step right back in.
What about the people actually running in the company? What does the insider activity look like? Are they buying?
It's remarkably neutral. The composite insider sentiment score is right down the middle at 54.2.
Okay.
There have been 0 open market purchases and 0 open market sales in the recent data feeds.
Wow, literally 0.
Yeah, insiders are just holding. They aren't rushing to the exits, but they aren't backing up the truck to buy more stock either.
So they are holding steady. Now let's talk about the risks. We've painted a very clear picture of the upside and the engines driving it, but we have to balance this bullish sentiment with a hard look at what could go wrong.
Definitely.
The bear case here is substantial, and it centers entirely on behavior.
The most glaring risk is that trading volume dependence. The entire bullish thesis breaks completely if the PDT rule change only created a temporary novelty spike in trading.
Right.
We saw it during the meme stock craze a few years ago. Retail engagement can evaporate as quickly as it appears. If retail traders get bored, or if the broader macroeconomic market cools off and volumes normalize, Webull's revenue will mean revert violently.
That is exactly why I'm so hyper-focused on Q3. A sequential revenue decline in the third quarter would be devastating to the narrative. It would prove the bears right.
Beyond the macro environment, there is massive internal execution risk. Expanding internationally and pivoting to institutional services costs real money.
Yep.
As we discussed, if their customer acquisition costs outpace their user growth, those beautiful margins will compress quickly. The cash burn will accelerate.
And we can't ignore the valuation risk tied to the chart. After a 43% rally over half a year, expectations are elevated. If the stock fails to hold above its short-term support, like the 20-day moving average around $7.70, it could signal a rapid loss of momentum.
Yeah.
Technical traders might start shorting it, adding downward pressure.
Those risks are entirely real. But to counter the fear of expansion costs, we do have to remember that massive cash buffer on the balance sheet. They have over $653 million in cash.
Yeah.
Even factoring in the nuances of broker-dealer float that you brilliantly pointed out earlier, that is still a formidable war chest. It allows them to fund their expansion across those 35 licensed markets, even if retail trading slows down slightly in the near term. They have a margin of safety to execute their pivot.
Okay, let's step back for a minute. Let's look past the immediate quarter and outline the 3 to 5 year blue sky scenario. What happens if management executes flawlessly on all three horizons?
Just to be clear, this is an optimistic scenario, not a guaranteed forecast or a prediction. But if everything aligns, in 3 to 5 years, this company transforms from a US-centric retail trading app into a consistently profitable, high-margin global digital brokerage.
So the post-PDT tailwind proves to be a permanent rewiring of the market, providing a massive, stable base of transactional revenue.
Exactly. They successfully scale across all 35 of their licensed international markets, becoming a truly global player with diversified geographic income.
And that institutional pivot.
It works perfectly. The private market SPVs, the prediction markets, the AI advisory, it creates a bedrock of strong, recurring revenue. In this scenario, that trailing net margin turns durably positive. The company easily justifies or even expands its 6.9 times multiple because it is no longer just a cyclical retail trading app.
It becomes a diversified financial technology platform.
Exactly.
So with everything on the table, what is the final wealth-building verdict?
Based on the research, the overall rating sits at a 7, which is firmly bullish.
The base case here is undeniable. The company has inflected to profit, boasting a massive 31.5% operating margin. They have a structural regulatory tailwind at their back, which leaves plenty of room for market sentiment to catch up to the new fundamental reality.
The biggest upside driver for the stock is absolutely that structural behavior change post-PDT, driving that 66% growth in trading income.
But the biggest threat remains a normalization of those trading volumes. A reversion to the mean would erase the Q2 surge.
In terms of investor fit, this is a great setup for growth-focused investors who are comfortable taking on execution risk for a potential multi-bagger.
Yeah.
But cautious investors, focused purely on capital preservation, might want to wait for those Q3 results to confirm that this new baseline is real before allocating. As always, as a reminder, this is not financial advice.
And if you want to organize your long-term stock research in one place, be sure to check out StockOracle through the special 14-day trial link below in the description. It combines fundamentals, valuation estimates, AI bull and bear insights, moat analysis, comparisons, watch lists, and portfolio tools, all into a single dashboard.
It's fantastic.
It is a brilliant research platform, but remember, it is not financial advice or a recommendation to buy or sell. AI insights and valuation estimates may be wrong, so always verify important information and make your own decisions. This is an affiliate link, and we may earn a commission at no extra cost to you.
And if you found this analysis helpful, please subscribe, like, and comment underneath. We'll see you next time.
Before we go, I want to leave you with a thought. If Webull successfully uses this massive regulatory windfall to fund their pivot into institutional prediction markets and AI advisory, ask yourself, are we looking at the next Charles Schwab, built entirely for the digital age, something to keep an eye on?